Have you been dying to start investing, but you have absolutely no idea where to start? Do you feel like investing seems like this super overwhelming thing that is only meant for rich people? Are you wanting your money to start making you more money? Well, then this video is the video for you. I'm Chloe and this is my dog Logan, and today we're going to talk about how to start investing as a beginner. If you're new here, I'm Chloe Bear and I am a financial coach and financial creator, and I focus on teaching people how to completely demystify their personal finances so that they can start building wealth and making their money work for them. I've received so many requests for this video, so I'm really excited to just dive in, and by the end of the video you should have a really good idea on how to get started with your investments, even if you're a total beginner. Alright, so after going in and editing, this is my editing input, my edit. This video would have been way too long for me to cover everything that I wanted to cover. So in this video, we're going to be covering what you need to do before you invest, your 401k and other retirement accounts. And then we'll also talk about different taxable brokerage accounts and then different type of assets. So in the next video, we'll talk about how to buy these and ways to invest as a beginner. So I'll share my strategy for investing as a beginner. Now, before we get in, let me just make one disclaimer. This is not investment advice. This is just educational purposes only. I am just somebody on the internet who is talking about money, so if you want to get professional advice, you should probably go see a CFP or a financial advisor. But essentially, this is just one part of the education that you need in order to get started. You do need to do some research on your own as well. In this video, we're going to talk about what you need before you start investing. We're going to talk about different asset classes. We're going to talk about why investing is so important. I'll give you the basics of some of the different investment types, and then I'll explain what you should do to get started. I'll even cover some of the retirement accounts and how those work. But before we get started, be sure to hit like and be sure to hit subscribe. It helps me and my channel grow a lot, and about 50% of my viewers are actually subscribed. So if we could bump that right up, that would really help my channel out. Let's get to it, and be sure to stay to the end so that you can find out my exact strategy for how I took my investments from $10,000 to $150,000 in less than 2 years. So the very first thing that I want to talk about before we dive into the basics of investing is you need to have an emergency fund before you get started in investing. And now, I am not against you investing in your 401k and getting your match while you're building your emergency fund, but I do think that an emergency fund should probably be your number one priority if you don't already have that. With that being said though, always get your 401k or 403b match. If your employer offers you a 403b or 401k match, take it. That's part of your salary, so it would be crazy for you to turn that down. It's basically saying no to money that is already owed to you. So make sure that you're getting that match, but also make sure that you're prioritizing an emergency fund. And for the most part, emergency funds, you should have at least 3 to 6 months of your emergency expenses saved. I have a video right here for how to create your emergency fund, so be sure to check that out before you get started in investing. Now, the second thing that I want to talk about is why it's so important to invest. Why should you invest instead of just saving? So let's first take a look at what it would take for you to save $1 million. Let's say you were saving $1,000 a month. It would take you 83 years to save $1 million. It's more like 83 and a half years. How long would it take you to get to $1 million if you were investing that $1,000 a month instead? So let's look at this compound interest calculator. So first we would put $1,000 in the initial investment. Then our monthly contribution is $1,000. Then let's just say length and time, let's make it 35 years and see what happens. And then estimated interest rate, we're gonna say 10% because on average, the stock market over the last 100 years has returned about 10% every year. But again, that's an average. That doesn't mean that every single year it returns 10%. It means over the course of 100 years, on average, it's about 10%. So we're gonna put 10% and variance, we'll just do 1% variance and calculate. So in just 35 years, you would have $3.28 million saved. So that's way more than the $1 million that we saved in 83 years with our $1,000 a month. So let's take that down to 25 years. Okay. So in 25 years, you would have $1.2 million saved. Now, that's a whole lot faster than 83 years that it would take for you to save $1 million yourself. And I don't know about you, but I'd rather reach $1 million a whole lot sooner than 83 years. And so the way to do that with the same amount of money is to be investing. You really can't build wealth by just saving. Like I said, if you were saving $1,000 a month for 83 years, then you would reach $1 million. But by 83 years, you're not gonna need that money anymore because you're probably So invest. So now that we've talked about the importance of investing, let's talk about how to get started in investing. So the very first thing that you should be doing, like I mentioned earlier, is you should be invested in your 401k if your employer offers you a match. No questions asked, get that match every single time. Now, Chloe, what's a 401k, you're probably wondering? A 401k is just a retirement account that's sponsored by your employer. So your employer is paying the fees for you to have this account, and the employer allows you to contribute a certain amount of your income to your 401k. Most 401ks offer an employer match, which means that for the same amount of money that you put in up to a certain percentage, they will match dollar for dollar or 50 cents on the dollar or whatever their match is, a certain portion up to a certain percent. So for example, my employer offers 50% all the way up to 6%. So that means if I put in 6% of my income, my employer will match half of that all the way up to 6%. To learn more about 401k basics, check out this video here. But the nice thing is, if you already have a 401k and you're already getting that match, good job, you're already investing. That's pretty great. Usually 401ks have a very limited amount of investments that you can choose from. A lot of the times they have things like target date funds, mutual funds, or even index funds. So we'll talk a little bit more about those asset classes later. Another thing you might want to consider opening is a IRA. So an IRA stands for Individual Retirement Account. And this is something that you can open even if you don't have a 401k. And it's also something that you can open really after any time after the age of 18. So the reason that we want to open these retirement accounts before we open anything like a taxable brokerage account is because you're going to save money on taxes. So the first thing that you want to do when you're investing is that you want to make sure to be investing in your retirement accounts. Why do you want to invest in your retirement accounts like your 401k and your IRA? Well, because you're going to get tax savings. Taxes are our hugest, biggest, baddest expenses here in the United States. Everyone pays taxes. It's the biggest expense, usually even beyond the expenses for things like our housing and transportation. So if you can find a way to save money on those big, huge expenses like taxes, well, then you're ahead of the game. Especially if you live in a place like California where your tax rate could be all the way up to 50%, you want to be able to reduce that as much as possible legally. Now, if you want to learn more about IRAs, you can check out this video here. But essentially, 401ks and IRAs are just buckets for your investments. So when you get an IRA or when you get a 401k, that itself is not an actual investment. A lot of people get that confused and they think that, oh, well, I have an investment, it's a 401k, or I have an investment, it's an IRA. And that's not what that is. An IRA and a 401k, those are both just containers. You put your investments inside of those containers. And these particular containers have tax benefits. Think about it like a pail and you're putting rocks in the pail. So this bucket is your Roth IRA. And when you put in stocks and mutual funds and index funds, those are all the rocks that go into the pail. Once you've maxed out your retirement accounts, and what I mean by that is you've put the $19,500 in your 401k and you've put the $6,000 in your IRA, then you consider opening something like a taxable brokerage account. Now, those are the things that a lot of people go to first. So you've heard of Robinhood, you've heard of Acorns, you've heard of Stash. A lot of people go straight to those instead and they don't choose the retirement options. Robinhood doesn't even have a retirement option. So you're paying triple taxes. In taxable brokerage accounts, that's why they're called taxable brokerage accounts, you're paying taxes not only on your income, but you're also paying taxes on your capital gains, which means when the value of a stock goes up in price or when the value of an investment goes up in price and then you sell it for more than what you paid for it, the difference is a capital gain. You have to pay taxes on that. If it's in a retirement account, you don't have to pay taxes on that. Another time that you have to pay taxes in a taxable brokerage account is that you have to pay taxes when you get paid dividends. So at the end of the year, when you report your taxes, you have to report any dividends that you made in a taxable brokerage account. However, if it's in a retirement account, like your 401k or your IRA, you don't have to report that because it's in a retirement account. And it's kind of like this little bonus that the government gives you in order to encourage you to invest in these retirement accounts. That's why I preach using those retirement accounts, because there's nowhere else that you're going to save money on taxes except for in these retirement accounts. Okay, now let's talk about the different types of asset classes that you can purchase. And what an asset class is, just a different type of investment, really. This one you probably already know, stocks. Stocks are basically individual shares of a company. So a company, when it goes public, it's basically opening it up so that you can own a part of the company. The reason that you would want to own part of that company is because as that company goes up in value, so do your shares. The stock is the collection of all the shares of that company. So when you purchase, let's say a share of Amazon is sitting at $1,000. If you purchase one share, that share is going to be $1,000. Purchasing individual stocks, in my opinion, can be a little bit risky because if one stock fails, let's say you have all of your money invested in Apple, and then someday Apple decides to go completely bankrupt, they make some bad business decisions, they do whatever, and their stock value tanks. Then your investment in Apple and the value that you put into it, the money that you put in it, that's also going to tank. So it's kind of risky because you're putting all of your eggs in the Apple basket. For me, I don't really like investing in individual stocks because of that. I prefer less risky investments that are more diversified, but we'll talk about what those are here in a minute. Another very common type of investment is called bonds. So bonds are different because when you buy a bond, you actually don't own any part of a company. Instead, you're basically giving a loan to a company, and then they are going to pay you a fixed amount of income for the length in which you hold that bond. So the returns on those are a lot lower, but they're also way less volatile than stocks. So what does volatile mean? Let me stop there. Volatile means the rate in which a price goes up and down and up and down. So you've probably heard that crypto is extremely volatile. That's because it can skyrocket in price in a day and then it can completely sink in the same day. Sometimes it can do that even in an hour. So it just goes up and down constantly. So we call that volatile. Whereas bonds just aren't as volatile. Bonds are pretty chill. You don't really make a lot. You don't really lose a lot because they keep the amount of value pretty much the same. These are considered relatively safe investments because, again, the value of it holds pretty steady unless the company goes bankrupt, tanks, things like that. So for the most part, a lot of the times, experts will say keep a little cushion of bonds in your portfolio, and the closer that you get to retirement, increase the amount of bonds that you have in your portfolio so that the value of your portfolio pretty much stays the same or starts to stabilize. Personally, I'm pretty far from retirement, so I don't really like bonds. Bonds really don't provide me any returns. So it used to be that you could get returns on bonds up to 5%, sometimes even more. Now bonds are sitting at 2% or lower, so the returns just really aren't worth it to me. They're not even keeping up with inflation. It really just depends on your risk preference. Personally, I'm not planning on retiring anytime soon, so I have a higher risk preference. I'd rather make my money make me as much as possible between now and when I retire so that I have a fatter bank account, a fatter investment portfolio by the time I retire. Another type of investment is called a mutual fund. Mutual funds are different in that they have many different stocks or other assets within the fund. So a way I like to think about it is funds are more like boxes of chocolates, whereas stocks and bonds are individual pieces of chocolate. So when you buy a Kit Kat, you're buying a stock. When you're buying a Snickers, you're buying a stock. When you're buying a Twizzler bar, you're buying a stock. But when you purchase a fund, you're buying an entire box of chocolates, and there are tons of different stocks, bonds, assets within it, depending on what mutual fund you're purchasing. Mutual funds can be great because they're totally diversified. So if Apple fails, you've got other stocks, bonds, companies, whatever in that fund cushioning that blow. So like a lot of people say, you're not putting all of your eggs in one basket. This is great in terms of diversification in the performance of your portfolio because it kind of makes your investment a little bit safer. Like I said, if one company tanks, you have hundreds of other companies cushioning that blow and making sure that you don't necessarily lose the entire value of your portfolio. Now, not all mutual funds are created treated equally. There are actively managed mutual funds that are basically managed by a professional. So it's managed by a Brad or a Joe who went to Harvard and Yale, and so they are actively trading in the account every single day to try and get the investors as much money, as much return as possible. Now, having an actively managed mutual fund is kind of risky in of itself because a lot of the times these don't actually outperform passively managed mutual funds in the long term. The thing is, they have higher fees. So with mutual funds that are actively managed, you have to pay Brad or Joe's salary. So even if your fund loses money in a year, you still have to pay them a salary for managing that mutual fund. There's another type of mutual fund though called index funds, and I love index funds. Index funds are designed to mirror an index. Basically that means that an index like an S&P 500, which is the Standard & Poor's 500 that contains 500 of the largest publicly traded companies in the US, an S&P 500 index fund is going to perform how that S&P 500 is performing in a given year. So the S&P 500 since its inception has returned about 10% on average every year. That's pretty good. Studies have shown that actively managed mutual funds, the ones where we've got the Brad or Joes in there trading every day to try and beat the market, actually don't beat the market all that often, because the thing is, it's really hard to beat the market. Now, what do I mean when I say beat the market? Say the market as a whole, the entire stock market, returns 10% in 1 year. Actively managed mutual funds are trying to beat that 10%. They're trying to get returns that are at 15% or 20% or 30% or as high as humanly possible. Unfortunately, we really can't tell what's going to happen in the future. So most of these times, these mutual funds fail to beat the market. In fact, mutual funds over the long term fail to beat the market 92% of the time. Index funds outperform these expensive, actively managed mutual funds 92% of the time. Completely insane. It's a no-brainer. I would much rather invest in something like an index fund that is known to continually perform according to the market that's doing pretty great over the long term. I also like being a lazy investor. An index fund, to me, index investing is a really lazy and effective way to invest. Index funds, because they are designed to perform according to a market, they're really low cost because you don't have a Brad or Joe in there trading every day. Instead, it's designed by an algorithm, and there's not a whole lot of things that you have to do once it's set up to perform according to the S&P 500 or whatever index. So the fees are much lower than the actively managed mutual funds, and they perform better. So it's kind of a win-win. Now, one thing to note about index funds and mutual funds is these funds you can only trade once a day, because essentially they're put together by a company, and the company decides when it's going to allow you to purchase these index funds or mutual funds. So unlike with stocks, you can buy and sell those all day long. With mutual funds and index funds, which index funds are a type of mutual fund. With mutual funds, you can only purchase them once a day at the close of the day. So when you purchase them, the price that you're purchasing for is whatever the price it is at the end of the trading day. Now, if you want to learn more about mutual funds, you can check out a video here. I talk about index funds and mutual funds in this video here. Now, the last asset class I want to talk about is ETFs. ETFs are called exchange traded funds. So we hear the word fund again, so we know that we're purchasing a box of chocolates. Now, ETFs are a little bit different from index funds and mutual funds because they can actually be traded all day long. So they trade like a stock. It's kind of a new investment class. You can buy ETFs that are index ETFs, meaning there are certain ETFs that mirror other index funds. So like VT-SAX is an index fund that mirrors the entire market. VTI is an ETF that mirrors the entire market. They're basically the same thing. They just have different expense ratios, and there's just the difference of when you can purchase it. So like I said, with ETFs, you can purchase VTI all day long or any ETF all day long. But if you wanted to purchase VT-SAX, which is an index fund, you would have to purchase it at the end of the trading day. So you can place your order at any time, but you will not purchase it until the end of the day. So whatever price it's going to be at the end of the day is the price that you would have to purchase it at. ETFs, you could technically watch how it goes up and down all day long and buy when it's low. That's not really something that I recommend doing. I like buying and holding and not really worrying about timing the market, because like I've said before, it is very hard to time the market. And if the Brads and Jones side of those actively managed mutual funds who studied finance, went to school to learn how to beat the market, still can't beat the market 92% of the time over the long term, well then I'm probably not going to be able to beat the market either. If you want to learn more about ETFs, I have another video on ETFs, so check it out here. And one more bonus that I forgot I wanted to talk about is let's talk about target date funds. So target date funds are kind of cool in that they are funds made of funds. So they're boxes of chocolates that have boxes of chocolates inside of them. That's kind of confusing, isn't it? The reason I want to talk about them is because a lot of 401ks have target date funds inside of them. So target date funds are interesting because they're the only type of investment that I'm aware of that contains mutual funds inside of the fund. Target date funds, they have a year on them. So you'll see like target date fund 2050. That means 2050, that's supposedly the year that you plan to retire. So theoretically, you would pick the target date fund that is designed for the year that you retire. Now, these funds have tons of different funds inside of them. So they could have index funds or they could have those expensive mutual funds. So you need to, even though it may seem really easy and you can just pick out the target date fund that has the year you want to retire, what I would say is look at the fund, see what's inside of there. Google the ticker symbol so that you understand what's inside of this target date fund. Target date funds change as the longer that you hold that fund too. So the longer you hold a target date fund, a lot of the time, the closer that you get to retirement, the amount of bonds you have in the target date fund is going to increase. That's kind of why I personally don't really like target date funds, but there are some good ones out there. So you want to make sure that you're not paying high fees, and you also want to make sure that it has the type of investments that you want in it. I like having a little bit more control over my investments, but target date funds are really great options for people who want a completely hands-off approach to investing, because essentially you buy the fund and in theory you just forget about it until retirement. I don't recommend you actually forget about it though. Keep watch on it, see how it's performing, see if it has too much bonds in there for you, because if you get to retirement and it was just totally padded with bonds the older that you get, and then your retirement fund isn't as aggressive as you want it to be, you're not going to have enough money saved for retirement a lot of the time. So don't forget about your target date fund just because it's one of those automated, easy investing options. Instead, keep watch on it, check it every couple of years, make sure it's performing how you want it to perform, and if it's not, then pick a more aggressive target date fund or start picking your own investments. Target date funds are usually less expensive than actively managed mutual funds, but more expensive than ETFs and index funds. So it's something to keep in mind. Some target date funds are really good and some target dates are really bad, because not only are you paying the fee for having a target date fund, you're also paying the fee for whatever investments are inside of your target date fund. So you really want to know what you're investing in. You want to make sure you're not getting charged tons of fees from not only the target date fund, but also the investments that you have in there. Every investment that you have inside of a fund has expense ratios. So check those out and make sure you're not paying an insane amount of fees. And fees can really eat away at your retirement portfolio. Just a 1% fee can mean the difference of having $5.7 million saved for retirement or $4.4 million saved for retirement. That's just a 1% fee over the course of 40 years. Fees really add up, and that's just at 1%. These fees are even more when you look at the expense ratios for each of the investments within a target date fund. While I think they're great options for beginners, I recommend generally learning how to manage your own account so that eventually you don't have to use a target date fund. But I see no issue in using a target date fund until you feel comfortable enough to manage your own investments. So we have to break it into 2 videos. I was being overly ambitious trying to squeeze it all into one. So in this one, you learned the importance of investing as well as different retirement accounts as well as different assets. And in the next video, we'll cover everything else. So thank you for watching. And if you haven't already, be sure to hit like and be sure to hit subscribe so you can see when part 2 comes out. So thank you so much for watching. I appreciate it. If you're not already following me on TikTok and Instagram, got Logan running around in the background. She got a new toy from one of my friends. And so anyway, thanks again for sticking around. Be sure to follow me on TikTok and Instagram. And I'll talk to you next time.